Hello everyone. We were looking at the accounting standard IFRS 15, revenue from contract with customers, and specifically focusing on the principle-based 5-step model for revenue recognition. We were covering the step 1 of this 5-step model, that is to identify the contract with the customer. In the last lecture, we extensively discussed different modalities related to step 1. We have covered contract attributes. We have covered contract criteria and the detailed aspects relevant to it. Today, in this lecture, we are going to cover a connected theoretical concept related to step 1, known as the combination of contracts. In the case of combination of contracts, we will discuss a simple scenario where if two or more contracts are entered into with the same customer or related parties, either simultaneously or nearly simultaneously, and then they comply with certain criteria, then these multiple contracts will be treated as a single contract. I will first read the provision and then provide an explanation. It says that an entity shall combine two or more contracts entered into at or near the same time with the same customer or the related parties of the customer, and account for the contracts as a single contract if one or more of the following criteria are met. This means that multiple contracts will be considered as a single contract, and the revenue recognition principle-based 5-step model of IFRS 15 will be applied to it. It is important to remember that in order to apply the concept of combination of contract, it is not necessary to fulfill all these three criteria. If any one of these three criteria is met, then we will account for these multiple contracts as a single contract. Criteria number 1, the contracts are negotiated as a package with a single commercial objective. This means that even if we have entered into multiple contracts with one customer or related customer, and if all these contracts have a single commercial objective, if the output or outcome of all these contracts are same, if the output of all these contracts is ultimately the same, if you will achieve one single good or service through all these contracts, then it means there is a single commercial objective, and now you will combine these multiple contracts into a single contract. Criteria number 2, if the amount of consideration to be paid in one contract depends on the price or performance of the other contract. If in multiple contracts, the price of one contract is contingent upon, is dependent on the price or performance obligation of another contract. This means that if the price of one contract is varying or contingent upon the price of another contract or dependent on the satisfaction or quality of work, then you can also combine the contracts here. And criteria number 3 is that the goods or services promised in the contracts or some goods or service promised in each of the contract are a single performance obligation in accordance with IFRS 15. So essentially, the same concept as the first criteria is being discussed here. That is, in one contract or across multiple contracts, the goods and services promised are being combined to identify a single performance obligation. This means that we are combining these multiple contracts into a single contract and then apply the principle-based 5-step model of revenue recognition under IFRS 15 to it. So, in this theoretical concept of combination of contract, there is a simple discussion that if a company or an entity enters into a multiple contracts with a single customer or related parties of the customer, either simultaneously or in close proximity, but all these contracts ultimately aim to achieve a single commercial objective or satisfy a single performance obligation, or if the price of one contract is contingent upon the price or performance of another contract, then it means these contracts were negotiated together. These multiple contracts essentially form a single negotiated contract, and you will combine them, assess them as a single contract, and apply IFRS 15 to it. Regarding this, we have illustration coming up. Let's cover them as well. First, it says Ādil Limited entered into two separate agreements with customer X. Agreement 1 requires delivering 10,000 bricks for $1 lakh, while Agreement 2 involves building a boundary wall for $20,000. We have a company, Ādil Limited, which has entered into two agreements with a customer, that is customer X. In Agreement 1, we are required to deliver 10,000 bricks to the customer at a price of $1 lakh, and in Agreement 2, we are required to construct a wall using these same bricks for $20,000. Now, if we look at these two separate agreements, ultimately we are achieving one single output, one single objective, which is constructing a wall for the customer. Secondly, if we consider the pricing, we are charging more for the 10,000 bricks at $1 lakh and less for the construction, that is $20,000, indicating that the price is dependent on each other. This means that we need to consider these two separate agreements as a single contract, as a combination of contracts, and apply the revenue recognition model of IFRS 15 to it. Let's discuss the solution. It says the two agreements should be combined and considered one agreement because contracts are negotiated with a single commercial objective of building a wall, and the price of two agreements is interdependent. Ādil Limited is probably charging a higher price for the bricks. In a similar manner, we have another illustration. It states a software company enters into a contract to sell software to Avengers Limited. 3 days later, in a separate contract, the software company agrees to provide consultancy services to significantly customize the software to function in Avengers Limited IT environment. Avengers Limited is unable to use the software until the customization services are complete. On the surface, we have two separate agreements with a single customer, one to sell the software and the other to customize it. However, the commercial objective of both of these agreements is same, which is to provide the customer with customized software that operates in their IT environment. Therefore, there is a single commercial objective here and there is a single performance obligation. Hence, these two contracts will be combined and treated as a single contract, and then the revenue recognition model of IFRS 15 will be applied to it. Let's discuss its solution. It says, software company determines that two contracts are combined because they were entered into at or nearly the same time and with the same customer, and the goods and services in the contracts are interdependent, therefore a single performance obligation. So this was a simple contract that exemplifies the concept of combination of contracts. I hope I have been able to explain this concept to you thoroughly. Let's conclude today's discussion here. Thank you.